Seth Masters, you're worried that a lot of dividend-paying stocks have become too pricey and are less safe. Now, I thought that the safety in dividend-paying stocks came in the coupon.
Well, of course, people do like income. And it's important to realize income does not mean safety, because you also have to worry about the price of the stock. If it fluctuates a lot and could drop a lot, that's not necessarily safe at all. And as people have rushed into dividend-paying stocks because they liked that income, they've actually bid them up to a point where they're not safe anymore. Right now, dividend-paying stocks are trading 50% more expensive relative to their long-term prices. And when you think about it, many of these stocks don't have a lot of growth. We think that's actually a substantial risk for investors.
What about financial stocks? Because the banks had a great year in 2012, certainly ran up, and they're certainly dividend payers.
Right, well, some of them are. Some of them aren't paying that much in dividends because, in fact, the government won't let them until they demonstrate that they've fully recovered from 2008-9. So I think what I would say is a lot of these financial stocks are still pretty interesting, many because they remain cheap fundamentally relative to their very strong cash flows, and also because a lot of them have, at this point, very broad businesses incorporating exposure to the world outside the United States, which helps diversify any risks they have here at home.
And what about utilities? Utilities sold off in 2012 because they were bid up the year prior. Are they safe again?
We'd say still not, because in fact they still trade at a premium to their long-term normal prices. And in fact, when you think about it, utilities tend to be very leveraged, they're very regulated, they're rather exposed to energy prices, and in fact their earnings growth forecasts based on the consensus are generally negative. That's not exactly what I would call a safe investment.
And what about technology stocks? Because a lot of big cap tech players have started giving small dividends because they can't find the growth anymore.
It's a very interesting development, and I think one thing that can happen in any sector, and I think we're going to start seeing some of it happen in technology, is that as the business model evolves, people will think less in terms of the sector and more in terms of the characteristics of the individual investments. When you think about it, there are so many different things that we currently call technology stocks. Some of them actually over time have the potential to actually be more like staples because so much technology is just part of what we use in daily life. Some of those may be the equivalent of P&G in the future. Others will continue to be investing a lot of R&D spend in narrow niches where they have a lot of volatility. They probably won't pay out as much in dividends, but they might have more growth potential. I think you're going to see the tech sector bifurcate a little bit that way in the future.
So if it's a case-by-case basis, where are you finding value right now? Where should people put their money?
Well, first of all, you should be pretty diversified because there are a lot of risks in the world. And we actually think, uniquely, there's a lot of value in most sectors of the market. There are cheap stocks in virtually every single sector. And there are also other reasons to buy stocks. There are stocks with good growth that are now in quite a few different sectors. So this is actually a good time for stock picking, we think, because you don't have to take a lot of sector-specific risk to find it.